Nobody sets out to become a disciplined trader. You set out to get rich fast, and the market lets you believe that for just long enough to hook you completely. That's the trap almost everyone walks into, and almost nobody sees it coming until they're 3 losing streaks deep, staring at a shrinking balance, wondering what happened to the person who was so sure they'd cracked the code 6 months ago. There's a shape to this, a predictable arc that nearly every trader moves through whether they're aware of it or not. 5 stages, each one testing a different part of who you are: your discipline, your ego, your patience, your relationship with risk itself. Most people get stuck somewhere in the middle and never climb out. A small number make it all the way to the top. Today, we're mapping that entire climb, stage by stage, so you can figure out exactly where you're standing right now, and more importantly, what it actually takes to move up from there. Let's start at the bottom. Stage 1 is pure impulse. No plan, no edge, just a screen full of candles and a gut feeling that today's the day. Picture someone opening a trading account for the first time, funding it on a whim, clicking buy purely because the chart looks like it's about to explode. There's no analysis behind that click. There's adrenaline. And for a moment, when the trade goes their way, it feels like validation, like they've stumbled onto something everyone else missed. That first win is intoxicating precisely because it was unearned, and unearned wins are the most dangerous kind because they teach you nothing except that luck exists. This is where psychologist B.F. Skinner's research on operant conditioning becomes uncomfortably relevant. Skinner found that rewards delivered on an unpredictable schedule, what he called variable ratio reinforcement, produce the strongest, most compulsive behavior of any reward pattern there is, stronger even than rewards delivered every single time. It's the same mechanism behind slot machines. You don't know when the win is coming, so you keep pulling the lever, chasing the next unpredictable hit. A first-stage trader is, without realizing it, running their own account through that exact loop. One win reinforces 10 reckless entries that follow it. The losses pile up quietly, while the memory of that one good trade keeps pulling them back to the screen again and again, convinced the next click is the one that pays off. The math at this stage is brutal. The overwhelming majority of new traders blow through their starting capital before they've developed anything resembling a process or a plan. Most quit right here, convinced the market is rigged or that luck simply wasn't on their side that day. But a smaller group, bruised but stubborn, refuses to walk away and moves forward into Stage 2 instead. Stage 2 is the information hoarding phase. Having realized that guessing doesn't work, the trader swings hard in the opposite direction and tries to absorb everything at once. Moving averages one week, Fibonacci retracements the next, then candlestick patterns, then option strategies, then whatever new signal service showed up in their feed overnight. Their charts start looking like control panels, 5 indicators stacked on top of each other, all flashing conflicting signals simultaneously, none of them agreeing with the others. The problem isn't a lack of information anymore, it's an excess of it, with no framework to filter any of it through. Knowledge without judgment doesn't protect you. It just gives you more sophisticated reasons to second-guess yourself in real time, more ways to talk yourself into or out of a trade based on whichever indicator happens to be flashing loudest that morning. This trader is still losing money, just now with more elaborate justifications for each loss than they had in Stage 1. Still, this stage matters more than it feels like it does in the moment. Every failed strategy they test is quietly building pattern recognition they can't get any other way, and every blown account teaches a lesson no course or video ever could. If you've ever hesitated on a setup you could defend perfectly in words and only realized afterward what happened, this is exactly why. And if that's landing right now, this is a good point to hit like and subscribe, because the next part is about the one thing that actually slows the fast path down, and it's not what most trading advice tells you to do. Stage 3 is where things get genuinely dangerous, because this is where a trader finally finds something that seems to work and mistakes that for mastery. Maybe it's a setup that's produced 3 winners in a row. Maybe it's a backtest that looks unusually clean. Whatever it is, confidence surges, and the trader starts believing they finally solved trading for good. Then, the market does what it always does to overconfidence. It reverses hard on the exact setup that just worked 3 times in a row, and the emotional whiplash is brutal. One week the account is up double digits, and they're mentally drafting their resignation letter. The next week, a single revenge trade, doubling down after a loss, chasing an entry they missed earlier, erases a month of steady progress in a single afternoon. This is where the work of finance professor Robert Shiller becomes essential to understanding what's actually happening inside a trader's head at this stage. Shiller spent decades studying how psychology drives market behavior far more than pure rational calculation ever could. And one of his central findings was that people consistently attach far more significance to recent, emotionally vivid experiences than to the underlying odds actually justify. A trader who just watched a setup work 3 times in a row doesn't experience that as 3 data points among thousands. They experience it as proof, and that inflated confidence is exactly what makes the reversal that follows feel like such a personal betrayal rather than simple statistical variance. It explains why a stage 3 trader will hold a losing position far longer than they should, hoping it recovers, while cutting winning positions early out of pure fear of giving the gain back. They're not disciplined. They're running on the exact same pattern Shiller documented across entire markets, just without knowing how to consciously compensate for it yet. Stage 3 isn't really about profit at all. It's a stress test. It's the market asking, repeatedly and without any mercy, whether a trader can survive their own psychology long enough to eventually develop control over it. Most traders don't survive this stage. This is where the majority quit. Not from lack of skill or lack of knowledge, but from sheer emotional exhaustion after months of feeling like they're 2 steps forward, 2 steps back. But the ones who push through, who start treating each loss as data instead of a verdict on their worth as a trader, start to notice something quietly shifting underneath them. That shift is stage 4, and it's the real turning point in the entire journey. Here, the questions change completely. Instead of how do I win bigger this week, the trader starts asking, how do I protect what I already have? That single change in framing rewires everything downstream from it. Missing a trade stops feeling like a missed opportunity and starts feeling like a bullet quietly dodged. Losses stop triggering panic because they're expected now, budgeted for, priced into the plan before the trade is even placed on the chart. Picture the same person from stage 1, the one clicking buy on pure adrenaline with their heart racing, now sitting calmly, placing a single well-considered trade with a predetermined stop-loss already set, and simply walking away from the screen afterward. No compulsive refreshing every 30 seconds, no emotional spiral if the trade goes against them. The account starts growing in small, steady increments instead of violent swings up and down. And there's something almost anticlimactic about how boring genuinely good trading actually looks from the outside once you finally get there. This stage is rare. Something close to 1 in 10 traders ever reaches it, but it's also not the finish line. It's the proof that the finish line exists at all, and that it's reachable through discipline and repetition rather than talent, luck, or some secret strategy nobody else has found yet. Stage 5 is the summit. The trader operating here isn't trading anymore in the way most people think of trading. They're running a business with a statistical edge that's been tested and refined over years, not weeks or months. Their strategy isn't perfect, and crucially, they don't need it to be perfect. A small edge applied consistently with strict risk control on every single trade compounds into something far more powerful than any single lucky win ever could. So here's the real question. Which stage are you in right now? Be honest with yourself. Are you still chasing the adrenaline of stage 1? Buried under a pile of indicators in stage 2? Riding the emotional roller coaster of stage 3? Up big 1 week and wiped out the next? Because wherever you land, the path forward was never about a secret strategy or a better indicator hiding somewhere online. It's the slow, unglamorous work of rewiring how you respond to risk, 1 trade at a time. If this changed how you think about the trade you hesitated on last week, tell us in the comments what setup you're going to practice small on first. Hit like and subscribe for more of this. Thanks for watching.